The world is drowning in debt. Global debt has reached staggering levels exceeding $300 trillion. This represents a significant increase in recent decades, fueled by various factors. These factors include low interest rates, government spending, and global economic expansion. The United States, as the world's largest economy, plays a central role in this debt landscape. The US national debt has surpassed $32 trillion. This is a figure that many find hard to even comprehend. This massive debt is the result of decades of government spending exceeding revenue. Social programs, military expenditures, and interest payments on existing debt all contribute to this growing burden. The scale of US debt raises important questions about the nation's economic stability and global standing. Is the US living beyond its means? Can it sustain this level of borrowing indefinitely? What are the potential consequences of such a massive debt load? These are questions that policymakers, economists, and citizens grapple with as the debt continues to mount. One way to assess the sustainability of a country's debt is to look at its debt-to-GDP ratio. This metric is crucial for understanding the financial health of a nation and its ability to manage its debt over time. This ratio compares a country's total debt to its gross domestic product, which is the total value of goods and services produced in a year. Essentially, it provides a snapshot of how much a country owes compared to what it produces. A high debt-to-GDP ratio indicates that a country has a large debt burden relative to its economic output. This can be a red flag for economists and policymakers who are concerned about the long-term economic stability of the country. A high debt-to-GDP ratio can be risky for several reasons. It can signal potential financial instability and may lead to a lack of confidence among investors and international markets. First, it can limit a government's ability to invest in essential services and infrastructure. When a country is heavily indebted, it has fewer resources to allocate towards building and maintaining critical infrastructure, such as roads, bridges, and public transportation systems. When a significant portion of revenue goes towards interest payments on debt, there is less money available for education, healthcare, and other vital programs. This can lead to underfunded schools, hospitals, and other public services, which can have long-term negative effects on the population's well-being and economic productivity. Second, a high debt-to-GDP ratio can make a country more vulnerable to economic shocks. Economic shocks can come in many forms, such as sudden recessions, natural disasters, or global financial crises. If a country experiences a recession or other financial crisis, its GDP will decline, and its debt-to-GDP ratio will increase. This can create a feedback loop where declining economic activity leads to higher debt levels, which in turn further depresses economic growth. This can lead to a vicious cycle of declining economic activity and rising debt levels. The more a country struggles to grow its economy, the harder it becomes to manage and repay its debt, creating a downward spiral that can be difficult to escape. Finally, a high debt-to-GDP ratio can erode investor confidence. Investors are always looking for safe and stable places to put their money, and a high debt burden can make a country seem like a risky investment. Investors may be less willing to lend money to a country with a high debt burden. This reluctance can lead to a decrease in available capital for the country, making it more difficult to finance new projects or refinance existing debt. This is because they perceive a greater risk that the country will not be able to repay its debts. When investors lose confidence, they demand higher interest rates to compensate for the increased risk. This can lead to higher interest rates, further exacerbating the debt problem. Higher interest rates mean higher costs for borrowing, which can strain a country's budget even further and make it more challenging to achieve economic stability and growth. Despite its high debt levels, the United States continues to enjoy a unique position in the global financial system. This is a phenomenon that has puzzled many, especially when considering the sheer magnitude of the national debt. US Treasury securities, considered among the safest investments in the world, are in high demand from foreign governments, institutions, and individuals. These securities are seen as a bedrock of stability in an otherwise volatile global market. But how can this be, given the sheer scale of US debt? The national debt has been climbing steadily, reaching levels that would be alarming for any other country. There are several reasons why US securities remain attractive to investors. Understanding these reasons can provide insight into the broader dynamics of global finance. First, the US dollar is the world's reserve currency. This status is not just a matter of convenience, it is a cornerstone of the global financial system. This means that it is used by countries around the world for international transactions and as a store of value. The ubiquity of the US dollar in global trade and finance creates a constant demand for it. This creates a constant demand for US dollars and, by extension, US Treasury securities. Foreign central banks hold large reserves of US dollars, further cementing its status. Second, the US has a long history of political stability and a strong legal framework that protects investors. This stability is a key factor that reassures investors about the safety of their investments. This gives investors confidence that their investments in US securities are safe and secure. The legal protections in place ensure that investors' rights are upheld. Third, the US economy, despite its challenges, remains the largest and most dynamic in the world. The sheer size and diversity of the US economy offer unique opportunities for growth and investment. It offers investors a level of diversification and growth potential that is difficult to find elsewhere. The innovation and entrepreneurial spirit in the US drive economic activity and create new investment opportunities. These factors have combined to create a situation where investors are willing to lend money to the US government at very low interest rates, despite its massive debt. The low interest rates are a reflection of the trust and confidence that investors have in the US economy. However, this situation is not without its risks. The high levels of debt and the reliance on low interest rates could pose significant challenges in the future. Investors must remain vigilant and consider the long-term implications of their investments. As the global financial landscape continues to evolve, the unique position of the US in the world economy will be tested. The interplay between debt, currency, and investor confidence will shape the future of global finance. In conclusion, while the US continues to attract investors despite its high debt levels, it is crucial to understand the underlying factors that contribute to this phenomenon. The reserve currency status of the US dollar, political stability, and the dynamic nature of the US economy all play pivotal roles. Investors must weigh these factors carefully and stay informed about the changing dynamics of the global financial system. Only by doing so can they make sound investment decisions in an increasingly complex world. The future remains uncertain, but the resilience and adaptability of the US economy continue to inspire confidence among investors worldwide. Section 4. The debt ceiling, a political tightrope walk. Adding another layer of complexity to the US debt situation is the debt ceiling. This term refers to the maximum amount of money that the United States government is allowed to borrow to meet its existing legal obligations. These obligations include Social Security and Medicare benefits, military salaries, interest on the national debt, tax refunds, and other payments. The debt ceiling is essentially a cap set by Congress on how much the government is permitted to owe. It is a statutory limit on the amount of money that the US government is authorized to borrow to fulfill its financial commitments. Congress sets the debt ceiling, and it has been raised or suspended numerous times throughout history to avoid a default on the national debt. Since its inception in 1917, the debt ceiling has been adjusted over 100 times, reflecting the growing financial needs of the nation. In recent years, the debt ceiling has become increasingly politicized. Lawmakers often use it as a bargaining chip in budget negotiations, leading to intense political standoffs. These standoffs can result in government shutdowns and bring the country perilously close to defaulting on its debt. Such political brinkmanship has led to several standoffs, pushing the government to the brink of default and creating significant uncertainty in financial markets. The mere threat of not raising the debt ceiling can cause market volatility, affecting everything from stock prices to interest rates. It's important to note that the debt ceiling does not limit government spending. Instead, it restricts the government's ability to borrow money to pay for spending that has already been authorized by Congress. This distinction is crucial in understanding the mechanics of the debt ceiling. Essentially, the debt ceiling is about ensuring that the government can meet its existing financial obligations. It does not authorize new spending but allows the Treasury to finance commitments that Congress has already approved. This means that even if the debt ceiling is not raised, the government is still obligated to make payments on its existing debt, as well as to fund programs and services that have already been approved. Failure to do so could lead to a default, which would have severe economic consequences. The repeated battles over the debt ceiling have raised concerns about the long-term sustainability of this approach. Economists and financial experts warn that the uncertainty created by these political standoffs can undermine confidence in the US government's ability to manage its finances. Some argue that the debt ceiling creates unnecessary uncertainty and risks damaging the creditworthiness of the United States. A downgrade in the nation's credit rating could lead to higher borrowing costs and negatively impact the economy. Others believe that the debt ceiling is an important mechanism for enforcing fiscal responsibility. They argue that it forces lawmakers to confront the consequences of their spending decisions and encourages a more disciplined approach to budgeting. The debate over the debt ceiling is likely to continue as the nation grapples with its financial future. Whether it serves as a necessary check on government spending or an outdated mechanism that creates more problems than it solves remains a contentious issue in American politics. As the political landscape evolves, so too will the discussions around the debt ceiling, reflecting the ongoing struggle to balance fiscal responsibility with the need to fund essential government services and obligations. Section 5. Can the U.S. default? Imagining the unthinkable. The possibility of a U.S. default on its debt is a topic that has sparked intense debate and anxiety. While such an event is considered highly unlikely, its potential consequences are so severe that it cannot be ignored. A U.S. default would have catastrophic consequences for the global financial system. If the U.S. were to default on its debt, it would mean that it could not meet its financial obligations to its creditors. This would be an unprecedented event in modern history, and it would send shockwaves throughout the global economy. Interest rates would likely soar, making it more expensive for individuals, businesses, and the government to borrow money. A U.S. default would also likely lead to a sharp decline in the value of the U.S. dollar. This would make imports more expensive, potentially leading to inflation. It could also reduce the willingness of foreign investors to hold U.S. assets, further undermining the U.S. economy. The social and political consequences of a U.S. default are difficult to predict, but would undoubtedly be severe. It could lead to a loss of confidence in the U.S. government, social unrest, and political instability.